Hello and welcome to the Q3 2025 market review. The last few months have been an interesting stretch for investors, to say the least. Despite constant headlines about rate cuts, inflation, and geopolitical tensions, markets have held up pretty well. So let's take a look at what happened and see what it means moving forwards. So over the past year, global markets have done very, very well. The Canadian stock market is up about 28%. The US market is up around 20%. International stocks are up roughly 18%. Pretty much everything across regions and sectors is up when you look at 1 year returns. If we zoom out to 5 years, the story is still positive. It's just a little bit more balanced. Bonds, which were hit hard in 2022 when rates shot through the roof, are finally starting to recover. As interest rates continue to come down, those earlier losses are being erased. Now, as I'm recording this, markets are dipping a little bit. And I actually think that's a good sign. It means markets are still functioning properly, repricing risk and resetting expectations. Honestly, if you'd have asked me at the start of this year to predict 2025 market performance, I wouldn't have said it would be this strong, not even close, especially given all the uncertainty that we've had globally. Despite all the headlines, wars, elections, trade tensions, Canada has done very, very well. It's been a bright spot. Trade negotiations have gone well. Corporate earnings have been steady, and the Canadian economy has held up better than most have expected. That said, there are still a few cautionary flags, especially globally, mainly in the technology and AI space. There is no question that AI has been the driver of this market cycle. Some of the world's largest companies are spending billions and billions of dollars on AI infrastructure and research. And so far, those investments have kind of paid off in excitement and earnings. But the reality is, most of that spending and profit is coming from a small handful of major players. So, yes, it's not a bubble in a traditional sense. There is real revenue behind it, but valuation still feels stretched, and a lot of the growth is still speculative. The market seems to be expecting that the massive investment in AI will soon turn into long lasting profitability, but we haven't really seen that yet. Does this mean that we're heading for another tech crash like the early 2000s? I don't know, but probably not on the same scale because there was zero earnings to back it up. But it wouldn't surprise me if we saw a very large pullback in that space. And this is where diversification really matters. It's really tempting to chase what's hot, but technology and AI are just one part of the global markets. Staying diversified ensures your goals aren't derailed if one sector cools off. And keep in mind, there are still plenty of areas outside of tech trading at reasonable valuations, producing strong cash flows and showing real stability. Another major theme for this year has been the devaluation of fiat currency. I know it sounds scary, but it's not new. It's part of how modern finance works. The concern today is that the pace of devaluation could accelerate, which has led many investors to flee towards traditionally safe havens like gold. Gold has been on a very strong run, hitting new highs as people look for stability, and it makes sense. Gold cannot be devalued in the same way currency can. And I personally am a fan of holding gold as part of a diversified portfolio, as part of a portfolio like a hedge for these type of risks. It can help offset risks tied to inflation and currency weaknesses. But the real takeaway isn't about owning gold. It's understanding the risk of holding too much currency for too long. And this applies to any fixed income as well, because you are holding currency. I am lending you $100. I am not buying 5% of a business. So it's different. So we just came out of a cycle of much higher interest rates where it felt comfortable to sit in cash or GICs. You could get close to 5%, which made waiting on the sidelines feel okay. And now many of these products are maturing and the renewal rates are much, much lower. Meanwhile, inflation has still eroded the purchasing power even when it was earning 5%. So we're now at a point where investors holding large amounts of cash need to decide what to do next. And avoiding market risk in exchange for certainty of losing purchasing power has always been a losing strategy over time. And the data shows that even in volatile years, staying invested beats sitting in cash long term. But I am concerned because the type of people that stayed in cash didn't invest, if they choose to invest now when markets are so expensive, is that a good idea? What if markets drop? What if the drop from markets means that they have this mindset that markets don't work? And that's the type of thing that is a little concerning to me right now. So a few takeaways, as always, that I want you to take from this is staying diversified. It's easy to get swept up in the hype. Right now, that's tech and AI. But the long-term winners are those that remain balanced, stay diversified, and avoid emotional decision making. Every year, we get reason to hesitate, but the markets reward patience and logic, not fear. Keep perspective. In the short term, moves feel urgent, but history rewards those who stay the course. Yes, valuations, especially in US tech, are high, which means that a pullback, I think, is likely at some point, but it doesn't change your approach to the long term plan. So that's it for Q3. That's all I really wanted to go over. Thanks for watching. And as always, if you'd like to talk about how these themes apply to your portfolio, reach out. I'm happy to help you stay grounded and make data driven decisions that work long term. On a quick note, we do have our annual reviews coming up, so keep an eye out for that invite. And if you haven't already, check out the Plain English Finance podcast. We have released over 20 episodes so far covering the basics of investing, planning, decision making. So if there's a topic that you'd like to hear sooner rather than later, let me know. I'm always open to suggestions. I have a list of 60 plus topics. So if there's something you want me to bring to the front of the queue because you want to send it to somebody or something like that, let me know. Anyway, thanks for watching. And as always, I will see you in the next one. Bye.